Hello and welcome to a new explainer vlog of Arthashastra Classroom. In this video we will explain to you, what is the stock or equity of a company, and what the different types of stocks or equity shares based on its classification. Stock or equity allows an investor to be a part owner of a company. In other words, a person holding a stock of a company ABC is entitled to the profit and bears the losses per the earnings of that company. If the issued capital of this company is 100,000 shares and an investor holds 1% of the issued shares, then he owns 1,000 shares of the company ABC. That entitles the investor to 1% of the value of the company ABC. Now that we know what a stock is, let's learn about the various types of stock and the basis on which they are classified. Stocks are divided into two categories based on their right to vote. They are namely preferred stock and common stock. Preferred stock usually comes without voting rights. Common stockholders have the right to vote for the board of directors. The board of directors oversees the managerial decisions of the company. Preferred stock has first lien on income distribution or the dividends of the company. In the event of winding up of a company, a preferred stockholder gets preference in asset distribution. So when a company is running as an ongoing concern, they get paid the dividends before common stockholders. And if a company decides to sell or close its operations, they get priority over common stockholders in asset sale proceeds distribution. Usually, initial promoters and angel investors get preferred stock. Preferred stock can be converted to a fixed number of common stock, but vice versa is not possible. Common stock, on the other hand, has voting rights. Usually, it is one vote for one stock that the investor uses to elect board members who oversee the management of the company's affairs and day-to-day business. Common stockholders can exercise control over corporate policies and can check management decisions if it is not in the best interest of the business and their stake in it. Usually, common stock is owned by the general public and institutions. It is either distributed by way of private placements like qualified institutional placement, also known as KIP, or initial public offering, also known as IPO. Stocks are classified based on income versus wealth creation. Income-earning stocks are known as dividend stocks and wealth-creating stocks are known as growth stocks. If a company distributes part or whole of its earnings amongst stockholders regularly, then it is paying a dividend to its stockholders. If a company decides to hold on to its cash and create value by employing such cash in an asset that adds value to the company, then that company is creating wealth through growth to its stockholders. Stock classification based on market capitalization. Market capitalization, or MCAP for short, is the market value of the outstanding shares or the free float of a company. Here free float refers to the stock that is held by the general public and available to be traded in the secondary market via stock exchanges. It is derived as the product of the total number of outstanding shares to its current market price. Based on MCAP, stocks are divided into small cap, mid cap, and large cap stocks. As per the rules of the market regulator Securities Exchange Board of India, stocks are divided into large, mid and small cap based on the ranking of their capitalizations. The first 100 stocks in order of ranking will be classified as large cap stocks. Listed companies ranked from 101st to 250th in the market cap rankings would be classified as mid cap, and all the listed companies ranked from 251st and below ranking are small cap companies. Small cap companies are generally small size companies with the potential to grow. However, it is interesting to note that not all small cap stocks belong to small-sized companies. The market price of a company that is lower than its fair value and has a small free float can still be a small cap company. In this case, it is not categorized as per the size of the operations of the company. Examples of such small cap companies listed in National Stock Exchange are Bajaj Electricals and Confin Homes. Both these companies belong to large corporate groups and have good cash and product portfolio at their disposal, yet figure in small cap space. Stocks with a market cap ranking of above 101 but less than 251 are categorized as mid-cap stocks. Generally, mid-cap stock prices are more stable than small-cap stocks. Companies that have established themselves and have steady growth potential are usually found in this category. The first 100 listed stocks in order of market cap ranking will classify as large-cap stocks. Most blue-chip companies with stable stock prices are in this category. The growth rate of these companies is lower than that of the small-cap or mid-cap because their sheer size restricts them from growing at the same potential. However, large-cap companies' stocks are stable and are the reason for including them in most long-term portfolios. In general, the growth stories of the companies will translate a small-cap stock into mid and eventually a large cap. The growth period ranges from few years to few decades to establish a change in the market cap of a company. Stock classification based on economic trends can be divided into cyclical stocks and defensive stocks. Companies whose profits are affected by the trends of the economy are known as cyclical stocks. These stocks do well when the economy is booming and move down when the economy is slowing down. Examples of such stocks are car manufacturers, auto ancillaries, hotels, and travel companies. Defensive stocks belong to companies whose growth is not affected by the trends of the economy. Their product or services range will be always in demand. Examples of such companies are FMCG, pharma, and hospital companies. There are other classifications based on value and risk which can be classified as under or overvalued depending on the intrinsic value versus the trading price of the stock. Stocks can be divided based on the risk they carry, as blue chip and beta stocks. Blue chip stocks belong to companies with well-established presence and brands. Beta is a measure of the risk and can be either negative or positive value. The sign usually denotes its correlation with the market and whether it moves in sync or not. Higher beta stocks are more volatile than lower beta stocks. Thank you for watching this video, and we hope that you liked the content of the video. Like and subscribe to the Arthashastra Classroom channel so that you get updates for new fun explainer videos.